All right, welcome to the Nadex Application and Strategy webinar series. My name is Darrell Martin. I'm with ApexInvesting.com. And to start off real quick, we always put up our standard disclosures and disclaimers. This is, trading. It's investing. It involves risk. Make sure you know what you do before you're doing it. This is unique information presented by ApexInvesting.com. And the standard disclosure as well, futures, options, swaps involve risk, which may not be suitable for every investor. Any trading decision that you make is your responsibility. This information is for informational purposes only. The contents of the are not an offer, solicitation to offer, buy or sell any instrument offered by Nadex, etc. The one cool thing about that disclaimer right there, as boring as they are and we see them all the time, is that it doesn't have any comment that says you can lose more than what's in your account. And so you don't have to worry about margin calls, being assigned things, negative cash balances, things like that from putting on a trade. And so it's really cool that you don't ever have to worry about that. If you've ever traded in futures or forex, if you've heard the horror stories of leverage on doing so, it's nice to not have that as part of your trading, and your risk is always controlled. You could always do more contracts, but you can't really increase your risk. You can't increase your risk of your position once you're in it. So there is a risk; it's defined, but you can't make it larger by moving stops, or the market goes crazy, goes nuts, blows out, whatever, flash crash day type thing. Your risk is capped. Before we even get into Apex, I want to encourage y'all that don't have an account right now, don't have a demo account, hop over here literally right now and go to trading at Nadex.com and go to demo trading account. Okay, so right there, trading, demo trading account. And then use that, fill that link out, takes about 15 seconds, okay? And put in your username that you want, name, phone, email, click apply for demo. You'll immediately have a demo account in about 10 seconds. They'll send you an email that has your password in it. Once you get that email, you'll be able to log in. Just click log in up here. Put in your username and password. They'll put $25,000 into your account of funny money. And I suggest you change your password to one that you won't forget. Okay? So go over here, just update your password to a secure one that you won't forget. The only reason I say that is because otherwise you forget it, you can't remember it, you can't log in, and all that. You can even put demo dash your username if you keep it short enough, and the password, and log in like on the iPhone app, the Windows app, the Android app, which is pretty cool. And if you want to get your demo account extended, like maybe it expired, if you'll just create an account and fund it with $100, it takes about 5 minutes to open a trading account. And place one trade. It doesn't matter whether you're risking $5,000 or $5 or whatever dollars. Okay, doesn't matter if you're risking $3. But if you place a trade, you can call you call Nadex up, your Nadex rep, and just call them right there at this number at the bottom, and they will extend out your demo for a year. Even with funding account, even if you're ready to go, even if you're already going, it's good to have that demo to try out new things, test out ideas. If you get that itchy finger trigger there, and you just want to start pushing the button. It's a good place to go to demo, and stay on track on whatever trading system it is that you do use whenever you trade. Okay, but definitely get those pieces put together as soon as possible. Like I said, you should have a demo account already. So now that I'm done talking with that, that should be done. If it's not, knock it out, because it's going to make everything a lot easier on you if you have that. The next thing is, some of you are brand new. Some of you have been trading for a while, and you're going to need some education. You want some help, want a place to ask questions, you want to bounce ideas off of it. You're trying things. You want to get some other traders' input. Hop on over to ApexInvesting.com, click on Get Free Access. Okay? And we have a live binary scanner, a live spread scanner, free. Okay? We have tons of information in here, over, I think, 200-300 hours at least of free education on Forex, futures, stocks, you name it, in the list. And then, so click on that orange button right there. You'll be able to log in, like I said, for free. And the biggest thing to start you out is, there's a lot of educational videos that are a little bit more in order than our YouTube site. And so, Nadex tutorials, like getting started, right there. And Nadex platform tutorials, Nadex Spreads. So you can go back and get sort of the basics in the 1, 2, 3. And then, so that's where all, basically, if you want to know how to trade, you can do that. And if you're trading at all, Robert, just give them a call again. They'll keep extending it for you. So don't worry about it expiring and it's gone forever. So they're basically, as long as you have an active account, yeah, they'll definitely extend it. Or at least they have extended it. I can't speak at what they'll do in a year, but I can't see any reason why they would not. I would be careful that I don't make a claim. Right? But and then under webinar recordings, this is where we'll put the bonus webinars. Okay, so if you want to see past Nadex webinars that we've done, we'll get tons of them in here. You can go in, they're cataloged, and you can check them all out. If you have questions about Nadex or trading in general, or data fees or data feeds, platforms, things like that, just go right here in the forum. And I mean, we have everything from psychology, money management, when should I trade what, what should I look at, interacting with other traders. Make sure you have your platforms, your computers, your data feeds, programs that help you on your computer that are free, like syncing your clocks and all sorts of things like that. Different strategies you can trade, systems for entry and exit, different ways to look at the market, how to find the best spreads, the best binaries, putting your plan into action, and then looking back over your day and saying, what did I do right? What did I do wrong? What do I need to repeat? What do I need to make sure I don't repeat? So that's sort of the idea behind it. If you're lost on all that, just use the general trading forum. We're constantly moving posts out of it. And it's actually doing really good. Sometimes it can get really, really deep. So just add them in there, and we'll move those, over into the appropriate section. But spend your time as you get a chance. As you're looking for things, there's a lot to learn in here. Just tons of questions that have been asked by a lot of different traders, and we're glad to help you out with it. Okay. And then the scanners are right here. So the binary scanners and the training is right here. So under scanner tutorials, and it'll take you to the forum section that has all the training. But if you go over here to, like, say, the binary scanner, you can click on that, and it'll load up the live binary scanner for trading on Nadex. And we also just did another major website upgrade, so our site is going a lot faster, and over the weekend, and it was time. So if you ever noticed our website ever lagging or being slow at all, we've taken care of the issue. Yeah, Darrell said so. Thanks, Robert. All right, so anyways, that gives you a quick walkthrough on this. You are going to want to use this because, again, we're going to talk about spreads, and we're going to talk about finding the best spread and targeting your strike. And again, this is free, okay? So now that we got that out of the way, let's hop on into what we're talking about today. I'm going to walk you through what the topic is. I'm going to walk you through a quick primer on spreads, okay? And then we're going to dive into how to use volume analysis to help you trade spreads, just like you should on any other market, and why that's important. All right, so we'll talk about incorporating Nadex spreads into your trading system. We're going to go to benefits of using volume for price target and take profit levels. I'm going to talk about factors to consider when you're trying to select the right Nadex spread for your profit target, and combining defined risk Nadex spreads and using volume-based targets to set your take profit. So I know a lot of that sounds the same, but there's small increments. But we're going to go through those, and it's going to be mostly charts and very few PowerPoint slides, okay? Let me get up a chart for you. And let's see here. We'll go through, and I guess we'll look at Russell, very common market to trade. And by the way, if you have a favorite, if you want me to pull one up, I will pull it up and we'll walk through it. Okay? So feel free to shout out your favorites and we'll try to see if we can get to it. All right, this is something I have learned from one of my trading mentors, and there's a lot of ways to apply it. But the big thing is that high volume bars, and this is not what we call a spike striker, which is like a volume spike where the market usually pulls back to that level, which works. It's pretty much the same thing, but this is on a little broader scale, okay? High volume bars create what's called a magnet price. And that's a price where the market is attracted to go back to that price after that price is touched. And so if you get a signal on whatever system it is that you use, and I'll be adding more to this, I just want to keep it really basic to begin with. But if you get a signal, then basically it's going to be a lot simpler to target a realistic price. And then we're also going to talk about how do I combine that targeted price with a realistic expectation on time it's going to take to get there. Because that's the two things you got to figure out. What direction is it going and how far, okay? So sort of like, what am I going for? That's basically the same thing. It's what price am I targeting? You got to figure out how long it's going to take to get there. Because with the spread, you have time as part of the equation. And the more you understand how long it'll take to get there with their objective expectation, then the better off you'll be when you choose your spreads. And some people think, like when they see my videos, because I have different strategies, they think, oh, he always does at the monies. Or he only does the lower spreads. Or, but I mean, I use the high risk spreads for doing iron condors. I love them. Did it on NFP last week. Worked awesome. Where I'll flip them around and actually had lower risk on the trade than a straddle trader did. I'll use the straddles a lot for news trades. I'll use the at the money trades to mirror the market. I'll use the low risk spreads to go in and hedge my futures trades or hedge my Forex trades, or even do the strategy we're going to talk about tonight. So we're going to talk about volume, and I'm going to get into volume first, and then I'm going to back out to spreads because I think that'll a little more application, model. And then we'll do a little, spread catch up and then spread combination there. So if I back out, I'm looking at a 10-minute chart, which I have found, and my mentor also taught me I've just watched it over the years, and it's actually been the most effective method to use especially for intraday trading, for looking at volume. All right, so 10-minute bars. Now, I'm not a big time-based bar person. I don't really care about time. But there is a factor time we have to look at, but it's just like at a certain measurement, like when is the volume too big, when is it too small? And 10 minutes seems to be very, very good at helping establish those magnet prices for us. And can you tell by looking at my chart? Okay, so this isn't like only the master guru can actually see this looking backwards because he can see that magical pattern. Can you tell where the high volume bars are? I mean, I'm not saying like the exact price because I know I would have to expand out the properties, but is it pretty visible to you? Like the difference between that bar and this bar down here? Let's see if anybody can see. Can everybody see my chart? All right, there we go. So I got to wake you up a little bit, okay? Because it's so easy to zone out. I want to make sure y'all are right there. Little interaction. All right, looks pretty obvious. Good. There we go. That's what I wanted to hear. So should not be that difficult to see it. And so if I'm going over here and I'm looking at this, and let's see if I can even adjust my numbers on here. It'll let me do it, because if I can, there we go, label font. I don't know if it'll let me do it here, if it's going to edit at that or not. There we go. That's a lot easier for you to read. Okay. All right, now you can definitely see it. Okay. Higher is the higher volume. Yeah, and what is volume? Volume is number of contracts traded. Now, remember, Nadex is a derivative. Okay, the price is derived from something else. What is a derivative? House insurance is a derivative. It's a product that is made that is derived from the value of your house. A mortgage is also a derivative of a house. Mortgage insurance is a derivative of a mortgage. So there's a derivative, just something is derived from something else. Even a stock in essence is almost basically a derivative, because it's a piece of paper, a certificate that is derived from the value of an actual physical company. And there's options on that stock, and so you can just keep going and going and going. But what we want to look at is we want to get as close as we can to the market, the actual underlying market we're derived from. And so the small cap 2000, for instance, is derived from TF. So the Russell contract. If you ever don't know the contract, you can do two things. Okay, that makes it really simple. One is just right here inside Nadex. Just hop over to indices, click on the contract, and you'll actually see the month right there. See, it says March. You'll see the month listed right there in the market. Okay. And then if you also go over here to our website, one of the tools that we have built in under Nadex information. And this is really good if you're setting up like your ninja charts or any charts favorites list, is current underlyings. This tells you every future commodity, indice, ag, all that fun stuff. All of them are listed right here with what symbol is currently being followed. So you can get the list in one simple page. And then when are they going to flip over? So this has when they're rolling, like this weekend, this coming weekend, crude oil and all the major indices are going to roll into the next month. And so you can go on this page and it'll let you know what month it's going to roll to right there. And it tells you like the ninja symbol. It tells you like the Thinkorswim symbol. So whatever it is that you're using right there. And then also currency futures. This is going to be an important thing for you for what we're going to be discussing tonight. Okay, even I know that Nadex follows, or maybe you don't know, but Nadex follows the what's called the spot market, like euro dollar. Okay, and that's the over-the-counter. Now Nadex is an exchange, but the spot market is like over-the-counter between banks, etc. It follows that, FX trading. There are also futures FX contracts. Okay. Some of them are really liquid, like the major ones that have basically the dollar in them. Okay, so dollar franc, dollar yen, euro dollar, pound dollar, Aussie dollar. So all the dollar-based pairs, or either dollar on either side, usually have very high liquidity in them. And you need to know when they roll over, because you are going to need to be aware of how to use this information, because you're going to want volume from the futures Forex contract. And I'll talk a little bit about what is the difference between Forex spot and Forex futures after we get down this first step of analysis. Okay, so we'll come back to that, and it's not really big or difficult or anything like that, but it's just important that you understand that you want to look at Forex futures volume for volume, because when you look at volume on spot Forex, you're just seeing what's called tick volume, which is how many times did the price change in that bar. That's it. It's not how many contracts were actually bought and sold. Okay. Right now we're looking at the Russell. We could look at a variety of different pairs, but first I just want you to see, especially Russell being as lighter in volume as it is, how obvious it is. And we can go through, we can look at, what are some of y'all's favorite things to trade? So maybe the S&P, the Dow, gold, right? But even, the Dow right here, you can definitely see the volume spikes. Now I had to back out. If I'm like right in here, zoomed way, way in on the chart, anything can look like a volume spike. Okay, I mean, check this out. Okay, now 100 contracts on the Dow looks like a volume spike because I'm zoomed in so far. So one of the things is you really want to back out of the chart. Look at the past month or so. Okay, I mean, look a couple weeks. You really aren't going to need that much far back. I just want you to get a real perspective. So yeah, you see it on the Dow. Yeah, we'll check it out on gold. Okay. So this isn't a hard concept. I'm just sort of walking through, making sure everybody has this down. So we got gold right now, and so gold. I mean, you can sort of tell there. I mean, you can tell where the big volume spikes are. But right about here, let's see. Let me add my toolbar on this. There we go. All right, and it's like right there. You can see that line. Maybe I'll make it that a little bit thicker so you can actually really see it. And like that. We'll dash it. Okay. All right. So basically, now we got sort of a high volume level of something we should be looking at. Now, if you really want to make it high volume, you could bring that bar up. The higher that volume is, the stronger that price is going to be for a magnet bar. Okay? So again, the higher the volume is, the stronger the price is going to be. So yeah, natural gas, we can go look at that one. That's a pretty crazy instrument. If you like trading that they can move 10% in a day. But yeah, you can definitely tell the high volume bars on natural gas. So crude oil, we'll look at that one. And then we'll get into a little more application side. And but anyway, so everybody can tell what the high volume bars are, right? It's not like you're really trying to, read the signs. So yeah, they're all a little bit different. Now also the roll, one thing that can be helpful is to be aware of what contract's flipping when. So to help you on this, if we go over here to metals, because this is the underlying market, is the gold contract on the CME over here. And I click on gold futures, and I can look at quotes, and I can actually see, you know, what volumes on what contract. Just making sure you're on, you know, the most liquid contract. I can look at volume right here and get all sorts of details. There's a bunch of information on here, but just to see, you know, what happens when on what day on what month, what contract is trading, how much volume was there, and there's a decent amount of volume. But yeah, gold is a much more lightly traded contract than people would expect. So it's because it's so popular with, you know, buy gold, sell gold, we'll buy your gold, all these little stores everywhere. But on the futures, I mean, it's not nearly as heavily traded. Same thing with copper and silver. They're not real heavily traded. So they can, natural gas, same thing, yeah. So they can really move quite a bit. But anyway, so I like to use, you know, methods like this. Also, you know, most popular indice in the U.S., the S&P. So right here, and I mean, you know, even with all the volume we have on the S&P, and I mean, you're talking 120,000 contracts, you know, 10 minutes. With all of that volume, it'll be right there. And let's see. All right, so a question about data fees on Nadex. They don't have any data fees. They're free. And they don't have any plans that I know of to increase that from free to higher. So, okay, great question. Some of you don't have charts. Thank you for reminding me of that, Bruce. If you need access to charts, hop on over here to home inside of our website. Start here. Okay? So on that page, you'll see a, you know, basically get free charts, how to get free futures data, how to get free Forex data. And you want to get both, even if you're just a Forex trader. Now, you don't necessarily need the Forex one if you're just a futures trader, but there's, it sounds funny, but what I tell people is like, it doesn't matter. People are like, I don't know if I understand the futures market or the oil market. And I'm like, if I tell you the price, 98.95, depending upon the, you know, time of year it is, you couldn't tell me if I'm talking about a stock, oil, or U.S. yen. You know, you don't know. It doesn't matter. Remove the decimal place. Forget the symbol. A chart is a chart is a chart. Now, does a certain instrument maybe have its own little pattern? Yeah, but it's not like you know Forex, therefore you know that pattern. And every spread on Nadex is the same. It's all $1. So, but yeah, so Bruce, if you go to that home start here link, you'll be able to get a platform and your data fees, or free data. Okay? And let's see here. Right over here on this. So if we're gauging, let's just say we back out a little bit, we're trying to sort of gauge, you know, some high volume prices. And our whole goal is to define where the market is going to be heading next. Okay? So let's just start like from right here, from this day. And we'll back out, sort of moving that over. I think everybody could agree without even trying that this level would definitely qualify for high volume bars. Maybe down to here. Like, how low can I go, right? So right there would really sort of cut off. I mean, that definitely separates the high from the low. There's a lot more below this than there is above it. Okay? Can everybody agree on that? Does that look like a decent level? About 40,000 contracts on the S&P? Yeah, the data is real time on the charting. Correct, Paul. Yes, if you use the home start here links. All right. So, you call it arbitrary if you want to. I don't think it's that hard to go, this is big and that's small. Okay? So it's all up to you. All I'm trying to do is show you how to read volume. And the guys who I've taught this to love it. Okay. So to keep staying focused on it, but we got about 40,000 contracts. And what I'm going to do is, if I go on, and I don't care what system you use, let's say I throw on, I don't know, like our MVP on here on 10 minutes, okay? And I'm trying to figure out what price is it going to go to, okay? Trying to target a price. And let me even get rid of like any signals on it, because I don't even want that to be the focus over here. There we go. I'm not even saying this is like the best strategy or system. Right now I'm just trying to get you to focus on the volume, okay? Because you can use this on any system. You can use it on systems we teach, systems you're using, etc. So this is my last like 40,000, price bar right here. So I'm going to go in, and what I'll do is, personally, I'll basically plot the highs and the lows. I'll just mark those up, okay? And I'm also going to go back. I want to try to find a lower price. Like, what's the next lower price I think the market could go to? So this thing's dropping down right now. Where do I think it could go to? Well, let's see. I have right here. Here's another level. That one's pretty close. So we'll just use this level right here. So just the low and the high. It's really simple. You usually don't see me teach stuff like this. But I love doing. I do it all the time with Tommy O'Brien on our Friday morning radio show, and we nail it. So you wait for that breakout, and then just bam. But we'll go over here, about the same. See, like you see that volume price again right there, like hitting those levels. Go back here. Okay, there's high volume. So I'm trying to make. You could sort of like call these support and resistance levels, but I'm not so much going for support and resistance. Even though it's what's called magnet pricing, okay? And so by doing this, now what I'm going to do is I'm going to sort of, scroll forward on the chart, okay? And then we're making new highs over here, so I'm going to have a problem trying to go much higher, right? So that is, I will tell you, that's one definite weakness, is on high volume bars, because really right there is the highest, I guess it meets the highest volume link, but that's about as high as we can go. Okay? So if I'm looking to go short over here, what am I looking to target? And, we're about to be the end of a trading day, but let's go over here. Let's go into like a new day. Okay, so I'm going to let the day be over. All right, so another high volume, spike right there on that thing. And we're going to go into the new day, because I want to start a new day with everything going. So if we go up, then I'm looking like about 1881. If we're going down, I'm looking for about 1871. Okay? And I'm expecting it to basically hit that area. And then if it breaks through it with volume. Okay, do y'all see what's happening right there on that chart? I mean, I could not have done that better. All right? Do y'all notice what was happening? Let me do it for you again in case you didn't see it. Remember, I drew these bars without knowing the prices and everything else. I would have just opened up Ninja and did this, okay? Look at the price. It spikes right there. It nails that last magnet bar, okay? And then just watch what happens. What does it do? Pop, hits it. And what's it doing? Right on it. It's like a magnet. It's holding the price there, okay? So it's looking for a reason to break out and go somewhere. Starting to pull up, but looking like a potential short setup. All right, so now it looks like we may be getting a short. We're looking for a break between, like below 1875, below that magnet, because that's where it's been bouncing between. If it breaks below that, maybe a move down to 1870. So, and ideally on some volume in that same process. If we get a volume break above, then we could be looking for a move up to 1881. Okay, right here. So we're just going to keep going. And this is just really, really simple trading. Okay. Okay, so we haven't had any kind of massive volume. So like right here, there's no volume. It broke. There's no volume. And I want the magnet price, the channel that's keeping it in, to have volume. So let's see if we can get some volume. And are we surprised? I mean, there's no volume. It's nighttime. Okay. So moving on forward. Basically back in the same place we were at last night, right? Nothing's happened yet. Okay, starting to get some volume. The market's starting to wake up. See how volume changes perspective as you zoom in and out? That's why I said you definitely want to zoom out when you're watching it. There we go. Okay, we're still stuck on this magnet. Market's just now about to open. Okay, so we're almost to market open here at 9:30. Bam! Now, what was that? What happened right there? You tell me what that bar was from. Any ideas? Oh, it was more than the open. Actually, it was before the open. Now, it wasn't a gap up. I mean, I guess it was technically a gap, but that's not what made it jump. There definitely is a volume spike. News. There we go. Okay, a little closer. What happened? This is on 3/7. Just happened this Friday. Biggest news event of usually the quarter. Next to FOMC. They sort of have a little tie, right? Yeah, NFP, unemployment. So that came on up. All right, so obviously, could you have gotten that trade? Did you have any volume there for you to know that that was coming up? I mean, you could have straddled it, or you could have iron condored it like I teach. But I mean, that wasn't really like a trade you could enter, right? But now we have what did we just make right here on this bar? What just happened? We just made a what? 40,000 is our average volume. This is an 80,000 volume bar. So what is this? This is a high volume magnet bar. So there could be new highs, there could be gaps, there could be all that stuff. What I want you to look at and see is massive volume bar, okay, compared to the average of 40,000. And if you want to really know the average, you can stick a moving average on your volume if you want to make it really simple. Okay. So what do we do when we get a massive volume bar there? I'm going to put this up here. I'm going to go ahead and add this one right here because, I mean, this is a very big bar just to give a little extra confluence there, okay? And now we got to figure out where it's going to go next. All right. If it comes back down, what price do you think on the way down? Yeah, I'd be expecting it to go down too because usually you see a big pullback after a massive volume bar like that. What price, and this is where the heart of what I want you to get to. What is the price you should target? So yeah, somewhere between 1878 and 1881. Yeah, like this range right here. Okay? So that's perfect. All right, so if you're expecting a pullback, I mean, there's sort of, your range that you're going for. And we're up here at 85 at the moment. Okay? Why is it important to know when you're trading a spread how far you expect the market to move? Like, how does that have any impact on you? So you can have a profit target, 100%, so you can know when to take profit. Okay, yeah, definitely. Well, if you're choosing a spread, you got to factor in, is this going to work for me? Okay? Can I be profitable on the trade? Now, right now on the S&P, if you're just going for 4 points, let's look at it. Now, in the morning, you're going to have new spreads at 8 o'clock. You're going to have 8 to 10 a.m. spreads. You're going to have 8 to 4 o'clock spreads. You're also going to have all the premium in the spreads like gone. But like right now, if you try to do that and you want to go short, I mean, there's a $235 risk spread that's right at the money. It's only a couple ticks away. There's one at 3, takes about $400. These other two, like that one's a little bit inverted there for you. But, you got to make sure you can overcome whatever the break distance is. So let's say you wanted the low risk spread on the night. It's 33 ticks. Now, Nadex ticks in always in increments of 1 on the spreads. Okay, we have the information on the ticks, like right up here for you. So Nadex tick size on the S&P E-mini or on the US 500 is 0.1. The E-mini ticks in 0.25, but the actual spread ticks in 0.1. So if it says 33, that's 3.3, okay? And so the reason I want you to think about that is if it has to move 3.3, basically that's sort of like a break-even distance, okay? I mean, not that you're going to lose all premium and everything instantly, but there's a lot of premium built in there. If it has to move that far to profit, and we're at 1855, okay, and our take profit says 1880, let's just put it down here, 1878, then we got what, like 7, actually we're at 1886. So if we're at 1886, we're down here at 1878, then that gives us basically 8 points, right? So we need to understand up front that we're giving up 3 points potentially on break even. Now, not that that money just goes way out of the gate, but you need to know how far do I think it's going to move to make sure I can overcome bid-ask spread, to make sure I can overcome proximity to underlying. If you don't understand it, then what you're going to do is you're going to go, okay, and this is what people do all the time on spreads. It drives me nuts. Because they're like, oh, these are horrible. And I'm like, just because you don't understand them. I go over and I'm like, oh, I'm going to take that one because that one is cheap. You know, and it's 11 ticks out of the money. And it's the euro dollar. And the euro dollar ain't going to move tonight. Okay? So you're going to buy a trade that, yeah, it only has a $7 requirement for you to put up money on it, but it has to move 11 ticks before you even get your $7 back at expiration. And the expected range is how much, how far between now and 11 o'clock. So they don't look at break-even distance. And so I'll use this in a couple ways, but one of the ways is I'll simply look at how far do I expect it to move, and then I'll use that to go, okay, what's the best spread for me? Because very often I'll actually choose a lower risk spread, which a lot of people don't know I do this, I guess, sometimes, but I'll choose the lower. I may choose this spread if I actually think it's going to move like 40 ticks. Because to me, that's much better than choosing this spread, where it only has to move 3 to be break even, because I have a lot less risk. I can actually do a whole lot more contracts if I want to. And I'm okay with the big break even distance if I have an expectation of movement, okay, of where I'm targeting it. If I'm not, then I go in and I got to use the smallest break even distance or proximity underlying as possible. So you look at that trade, and most of the trades you could have found 8 to 10s. You know, they would have been about right here. Okay, so 8 to 10, and they would have been 10 points wide. So you probably would have been like 1880 to about an 1890. So you'd been about 4 points in. You had about a $40 risk on the trade for one that came in right there. Anyways, high volume bar. Now we're going to use this because we know we don't have anything above this. So right here would be our target if it's going to come back down. So we can either take our profit, we can set a take profit limit order in on Nadex up front. So it starts hesitate. See how I hesitated too? I went fast, but really, I mean, that's like first 10 minutes, news announcement, bam. It's sort of chilling out. All right, so you have time to get in this trade. I didn't like it's just hanging, you know, doing nothing. It's like, okay, there's nothing going on, and now here we go. And the market starts moving. Bam! Look at that. Look at what happened. Right there. Okay, what is that hour? What's this hour right here? What just happened? So that one was NFP. What was this one? It's at 9:30. What happens at 9? The market opened. Yeah. So not a big surprise. And the market opened after the NFP news, right? Because think of it, all these stocks now are getting to start trading, which are the 500 stocks of the S&P 500. Boom, there's going to be a lot of volume going on. And so, I mean, now you could literally, if you wanted to, and after a while you got to go clean up your lines because they get a little messy. But you got another volume bar there, and really you could put another one right here, right? This is a bigger volume bar than that one. So you sort of got another little level. It's just really simple trading. This isn't, you know, genius trading. There's not really any indicators on here. I'm just trying to go really basic because I really want you to see volume. Okay? Then goes down. Pop. Hits our next level right there. Same thing happens. Okay? But notice how it's hitting that magnet price over and over again. Right there, the next magnet price. Back to the magnet price. Right back to the magnet price, right next to the next magnet price, okay? So, whoops. Now we've cheated. Now we see everything. So, magnet, I mean, now it's just oscillating between them. And these magnets will make better support resistance levels than you're ever going to get trying to draw them on a chart. And look at that. All day, that's all it did. It stayed right in between those magnet prices. And so we had that really strong one that happened right from the open, okay, that we had back from the NFP, not the open, but the NFP. And then we had a couple more levels back here, and we can look at those. We can sort of like pick that and go, okay, what day was that on? And that was right there. So that was the previous day. By the way, that was the previous day's high volume close. Okay, right before NFP. That's what this level was right here. All right, and then if we go back a little bit further, you know, and I mean, you can keep just tracking these. But you got to find a lower one. There we go. So right there, the previous day's high volume close. So right there, and it lines up. So those closes are lining up to be really solid, you know, what you could call support resistance levels. So, and I'm not even talking about, you know, the traditional just volume spike, because we talk about volume spikes a lot at Apex. So I want to make sure that, you know, the Apex traders on here aren't getting confused with that. But this is just high volume bars. Now, I can then combine that if I wanted to look at volume spikes, which are, I mean, there's nothing fancy about them. It's just what they are is they're high volume bars where bars on both sides are half the volume of the other side. So if you have like 100,000 volume and the other two have to be 50,000 or less. And so this will show me like on 5, 10, and 15 minutes, you know, where their volume spikes. And yeah, right there we got a volume spike. It turned around, which is actually where we expect a reversal. Came on, back down. We got another volume spike right here, which is where we expect another reversal. Another volume spike, expect another reversal, another reversal. So that helps us. The volume spike lets you see like where you expect the reversal, but the high volume bar lets you see where to target the price. It's that magnet high volume bar. And so that's what I'm going for. Okay? Yeah, so find your highest volume levels, and I mean, you can go nuts and you can literally have like 50 lines on your chart, which means you can't read anything. You might as well have 50 indicators on your chart. Okay? What you want to do is just go through and, again, 10-minute bars. Okay, I'm very big on the 10-minute bar thing on this. And that's why you'll see often when you see my charts, you'll see 5 and 10-minute because I use like 5-minute for volume spike reversal entries, and I use 10-minute for price determination of where I'm expecting something to move to. But by having that expectation of price, you can either take profit, or you can say trailing stop, or, you know, you can look for maybe a contrarian trade, like maybe a bounce off of that. There's a lot of ways to use it. But, I mean, you can see, I mean, that wasn't some, like, perfect little setup example. I mean, I just pulled it up. I was out Friday. I mean, I traded NFP on my phone, traded Nadex. I was at my daughter's school, so she won, like, a talent show award, and I was, like, a dad sponsor at the science fair and shot off bottle rockets and stuff like that. Not real bottle rockets. What do you call those? I don't know, where you mix the stuff with Coke. And all this sounds bad, doesn't it? But where you mix like Mentos and all that, and you like launch off the, you know, Coca-Cola bottles. And I wasn't trading. I hadn't even looked at this chart. I just wanted to walk you through. This is a volume chart. This is just how volume works. So, not Pop Rocks. That might make it better, though. Who knows? But anyway, so right here, I mean, you just see how it's just, it really, I mean, it's some of the best support resistance lines you could have possibly drawn without ever having to become a support resistance line expert, okay? So now I can add in other things to help out with that. Like maybe I go and I add in deviation levels, okay? And we have these on our website for free. You can pull them off the site and chart them, or, you know, auto chart them, see how they line up. And they can add a little confluence, like right here. You know, we got 2 deviation levels there. We're pretty close on this one. So we're sort of right at the settlement. Basically, it's bouncing between settlement. But they can add just another layer of confluence onto it. Up to you. So I'm just trying to like show you a couple things. The biggest thing, this is probably the next most important thing I want you to understand, is how long is it going to take to get there? Now, this is a little bit unique because it's a massive move on news, okay? But you really have to have an expectation on how long it's going to take the market to move a certain price. So this shows me like how far I expect the market to move. We talked about this last week on the last week's webinar, about how far I expect the market to move. So if you combine how far you expect the market to move with how long you expect it to get there, okay, then you can better accurately go in and pick the right strike. This is not necessarily a perfect example, but it's a good example to display my point. We were doing, I want to say it was Aussie retail sells a couple weeks ago, doing a trade on that over in the trading pit over on our site. And we're looking at it, and there wasn't like this perfect trade setup. Didn't really like the balance of the strikes. The long side was great. The short side, like if it hit my profit target, I'd make $8. The long side, I'm making like 35. Okay, and I'm risking 35. So I didn't like that whole 1-to-1 reward scenario. I went back and I looked at the charts, looked at the expectations of movement, and found out that within 15 minutes of that report, like 9 or 10 out of the last 12, actually like 10 out of the last 12 reports on the Austin retail sales made their move in the first 15 minutes. Okay, and like 80 to 90% of their move. And after that, like if it hadn't happened, it's not happening. You might get a few more ticks out of it. And so what I did is like, you know what? I'm going to go ahead and if it happens in the first 15 minutes, I don't need to buy at 11 o'clock. I can buy an 8 o'clock for the 7:30 release. And because I only need 15 minutes. And so I put in a buy above, a sell below, got me lower risk because I didn't have to spend money on premium, on time. And I was able to go in with that. And I set my 1-to-1 on my long and my short just in case the news just popped. And if it didn't, I know that the biggest move it usually makes is within 15 minutes. So if I was only like close to that break-even price at 15 minutes, which is what I was expecting to be at, okay, then I'll take it off. But if it moves up, hey, I got my profit. Well, I put my short 1-to-1 on, flew down, took my profit like within 2 minutes on the short side. And that was at a 1-to-1 take profit. I was only able to do that trade because I had proper expectations on movement. And I was only able to do that trade because I had proper expectations on how fast the market was going to move. Like, not fast in the sense of like how fast it's going, but fast in how long it's going to take to get there. And so whenever you go in and you're selecting a strike based on, say, volume or whatever other type of analysis you're using, but volume is a great way to select a spread. We'll talk a lot more about binaries next week with this exact same analysis model. You want to think, how long is it going to take to get there? Is my spread going to expire before it even makes the move? Okay? And so we had a pretty high expectation of movement. Right there. Like, so you can see our movement right there. That like these little green and red boxes are how far we're expecting the market to move on a given hour. Okay? And so calling it pretty well, but it's allowing us to accurately, I'm not going to say accurate like as in 100%, but accurately as in allowing us to easily be able to go in and have at least some sort of objective, realistic, not just I think because I want it to move fast because I want to make a whole lot of money, so therefore I'm going to buy this really short one because it's really cheap, and I really think this is the price it's going to because I got like a Fibonacci level and a Gann and a golden ratio. I got a support resistance, and I have a volume level, and I have a deviation level, and whatever you have on there. I have 12 things, and they all say it's going here. Great. Bet you're right. You probably are right because there's a lot of orders there if all those things are lining up. But are you right about how long it's going to take to get there? And so that's where you want that expectation. And so like if it doesn't line up with the expectation, then I'll make it 2 hours. So I'll go in here and just do this. And I mean, there's a lot of ways to look at expectations of movement. There's linear regression channels and all sorts of stuff. This is based on hour of the day, day of the week on any instrument on the planet. Okay, so that you can chart. That's what this is. And so it's how far, like, it literally breaks it down by every single, or 2 hours of the day, or whatever. And so if my 1-to-1, or if that price target is not within my range, I got to go, hey, well, what about if I have to have 120 minutes for it to get there? Will that work? Yeah, that works great. Okay, cool. Well, now I have the right, potentially the right expiration for my trade. So the trade doesn't happen like right after the thing's over. Okay? Does volume print before the price moves? Volume and price are both, pardon me, both live. Volume can move without the price moving. Okay? Price can move without volume moving. Because price could jump and then an order's filled. Okay, because price is price discovery. It's literally bid and ask. So unless you have price on last, which is usually what I have my data set at, because I have it set at last. So therefore, my price doesn't move unless it was filled there. But if you have it set on bid or ask, like bid and ask can constantly be moving because it's trying to fill orders. Now ES, it's getting filled, but other markets that are less liquid, that bid and ask can move a lot. But volume is live. So it's as a contract gets filled, that volume's happening. You'll see the number go up. So if you're watching it live, just watch the chart. You'll see that. After a massive volume spike, I usually do expect a retracement. Yes, that is an accurate statement. So I'll look for a volume spike. Now I actually use this as a spike tracker for when I expect a retracement. Okay, like right there when I get this bar is double the size of these two bars. That's what that's telling me on the 10 and 15 minute both. And then I'd wait for it to pull back and break below. I'm real big on this rule. Okay, if I'm trying to do a fade the market thing, I'm real big on I want it to break below the low of this bar if I'm doing like a spread trade. And so if I'm going to target this massive low volume right here, which is what we said we were targeting. Okay, so we're going right for this price. Right there. Okay. Then once it breaks the low of this bar, it doesn't do it. Once it breaks the low of this bar, it doesn't do it. Finally, it breaks the low of that bar. Right there, it breaks the low. Then I got my entry. And now I'm going short. So, right there. Yeah, I did a ninja like reset earlier today, so all my charts don't have all their regular pre-configs built in right now. Okay, so like right there. It's going in, and then you could take off. You could trail. I mean, that's up to you how you want to do. If you just want to target the magnet price and say that was my trade, it worked, I'm done, I'm out, next. You weren't going to get that much more out of it, maybe a couple more points, and a lot more stress. Because here's what happened: this bar came down, it opened up. All right, let me see if I can get let me grab this. This bar opened up, it went up a little bit, it came on down where your profit target could have been. It came back up, it closed here. Now you're afraid that you're going to lose it all, right? And then it moves back up here. Now you close the thing out and you give up all your profit because you're freaking out. And then it moves on back down, and then it closes out here. And then it goes down. Now you think you're going to make a fortune, and then it goes back up. It closes here, goes all the way back up here, finally comes down. Yeah, you could have made a lot more. So just depends upon what strategy, what system you're using, and how you're trailing your stops. That's a whole different webinar on best ways to trail stops. But the biggest thing of this is I want you to target prices and have an idea, have an expectation of how far it's going to move. Have an expectation of how long it's going to take to get there. So now that, again, that's on volume-based reversal trading. I also would just simply short the market simply because it met its expectation by 75% or more. Basically, the market moved far enough that this is the expected range, and I expect it to pull back anytime it meets that range. As you'll notice, it doesn't really break out of the boxes too often. So that's even an NFP day, and it didn't break out of the expected range. But does that help, Ken, as far as the volume and price at the same time? Yeah. Okay, so that's one example. What is another? Let's look at a Forex market for an example, okay? Because it's a little bit different. I don't know. Let's choose US yen. That's probably the most popular pair on Nadex is US yen, because they have strikes every hour, and they're only 5 ticks wide on binaries and all that stuff. But they also have spreads every hour. They start from 6, 7, 8, 9. There's a new one starting up that's 2 hours long on all the FX pairs. So we'll check out US yen, or on 8 of the FX pairs they have spreads. And right there. I thought I set that to 24/7. All right. All right, so we got default 24/7 set. Okay. And what did I say the problem was with Forex volume? And I know like every Forex trader hates this when I tell them this because they're like, well, I use MetaTrader and they don't have it. What's the problem with this volume? Yeah, it's tick volume. It's not actual volume. It's number of times the price changed in that bar, okay? Depending on your data feed. And even with that, it's going to be limited. So we're going to go over here, and we're going to add another data series. This is how I do this, okay? So if I'm in Ninja, and you can do this on whatever platform you want as long as it has volume, I'm going to add 6J. Click New. I'm going to make it 10 minutes also. And then what I do is I actually make it transparent. I don't want to see it because it's upside down. It's going to flip me out. Okay? Because it's basically yen dollar, but it doesn't matter. Volume is volume. Same bar, same time, same instrument. Okay? Or always the same underlying there. And then transparent. And hit apply. Now I'm going to go in and I'm going to add volume again. Okay, just regular volume. I would not suggest doing up-down volume because you'll get really confused. Because like I said, they're inverted. But new. And then I'm going to say, put it in the panel I assign it to, and assign it to the 6J closing price. You can get access to the platform and the data fees and all that, volume, all that, obviously free. Okay? And click OK. Now, you'll be amazed that sometimes they're incredibly similar, but there definitely is a difference. Okay? Is that what you think? A little bit of a difference over here. So we can see that. Obviously, there's some massive volume times, some low volume times, some high volume times. Depending upon which market, which contract you're looking at. But you can go in and you can basically add these markets to see, where you're really high volume. I mean, that's a massive volume right there for this contract. So like right up here, you got 24,000 contracts on it. And so you can use that same thing. You could use this to plot, what would my levels be? And I'll just go, I mean, if you want to work your way down, you can work your way down. Like you go, okay, well, this is obviously a high volume bar. So it doesn't take anybody, but I mean, anybody, 2-year-old could tell you that's the biggest bar. Okay? So right there, and just stick one on top and stick one on bottom. Okay? The high and the low. Okay? Now let's go over here, and notice I do line up because there was a lot of tick movement. So that one's really obvious. But right there, yeah, I got 60, what do we got? Like 19,000 contracts. So do the same thing. Let's add that. We're going to look at this one and go, how much more does this tell us? Well, that's actually, look at that. Okay, so look at it came down. It came back to that magnet price. Boom. Okay, it made a new magnet price. And we can go further and further back. We can add more and more in. And let's just look forward a little bit. Okay, like what happened? If we go forward over here, let's pull this down. Okay, at the weekend here. So it opens back up. And notice how it comes right back down. And it's staying inside these prices. This is going to help you a lot in your realistic expectations of how far the market's going to move. Do you need this really for a boomerang? Not really. I mean, you could add it on, make it more complex. But look at this. I mean, we're looking for a move like either up to this price or down to this price. And again, look at the expected range. Okay, right there. So there was only a couple times in the day where we even thought it might hit that price if it went down there. So there's not even a massive impact on that. So you go, you know what? No major trade, nothing's happening. It's not going down to my price. I already had 75% of expected move. But just, you want to plot these levels. You keep up with them, and you'll really start seeing over and over again how they get hit again and again and again and again. And they make really, really good price targets. They are for bigger moves. They are not for your smaller, they're not for 1 and 2 point and 3 point moves. They're for $1 moves, okay? Or for 10-point moves. We can go in and let's see, we can change this. Let's look over at maybe gold, okay? You could use, you can definitely use this for swing trading. You can even use it for trend trading. I mean, the market's breaking up. Now, the hard part about right now on trend trading is unless you're trending down, because we don't really have a lot of up to go towards, right? Unlike the indices. But Here, let me take off the 6J data series. We'll hop over to something like, oil or gold, which is a lot less liquid. And let's just see. And sometimes, by the way, the drawings will carry over on your charts, and you may not want those. If they do, you can. This little button right here will remove all the drawings from your chart. Okay. But so here we got oil right now, and just looking at it. Okay, what fair to say that's a pretty decent right there level. Okay, like encapsulating, you pretty much see all the spikes like hitting that level. Okay, and let's just again sort of start back, like say right here, just like we did before. Okay, and then let's just look at what spikes are there. Let's just start plotting some very simple, there's some lines. I mean, I'm not trying to teach you how to be a trading genius, but you'll be amazed right here. Like, it's really cool. And let's see, we got several right there. See, we're hitting that same level again and again and again. I don't need to draw the line over and over and over again, unless it's just something that's massively huge that I want to pay attention to. Let's see, right here, and we're getting like several big bars right there. So I can go in, I can layer these as much as I want to. Right there, so basically that's the high and the low of those 3 bars there. Scroll back a little further. Basically I'm just trying to get a little range. Okay, built in. So we got those covered. Trying to get some prices above and prices below where I'm at right now. So, because if I don't have anything above or below me, it's hard to have a magnet price to go towards. And the reason it's a magnet price, why does it what's the logic behind it, behind simple magic of volume, is because that's where the orders took place. That's the last place they stopped getting filled massively. Okay, so there's a lot of demand there. And if you ever heard me talk about the apex pattern, how the apex pattern works, and the whole idea behind it, is that whole magnet right there. That's like over and over. We're seeing a lot of these line up. Is the market goes to where the orders are. Okay, that's just how it works. And I think sometimes you can easily get caught up in trading a derivative, whether it be an option or a binary or a spread or call puts or whatever. You forget to think about looking really at the underlying market. And so you want to go over and you want to look at it. You want to find where are the demand levels? Where did a bunch of people put their orders? And that the markets go back to the magnet prices. This works on a daily time frame. I mean, this works on a weekly time frame, but you can literally trade this like for daily bars. And I'll have people that call in about stocks that I've never looked at in my life. I've never even pulled up the ticker. And they're like, "Where do you think this is going?" And I'm like, "It's going here." And I'll base it 100% based on volume. And they'll call me back 2 minutes later, like, "Hey, it went right there." And I'm like, "Exactly." So it's just the volume. I mean, that's it. So okay, so we got like a pretty good sample size here. Let's move forward. All right. We gotta get past where we drew all the lines, which is like 3.6 is where we started drawing them. And there we go. So that we're on 3.6. So we started like 3.5, so we're on 3.6. So you can see, boom, boom, going down to magnet prices, making magnet prices. We'll move forward and see where it keeps going from here. Okay. Okay. So like right there within a couple ticks. That one. All right. Bam! Got it. Right to the magnet. So get down there. See what it does. That's just going to go flat on us at nighttime. Look at that, though. Look at that. I mean, you can get a better support line than that. Just check that out. Again, totally different instrument. Oil. Okay? And it's just like boom, boom, boom. Right against that magnet. So basically, it needs some volume to pull away from the magnet. So it's pulling, it's trying. It gets sucked right back up to it. Okay? Try to go above it now. See if that'll work. Oh, market's waking up. Got a little Europe session going on. A little volume happening, pushing some oil around. Not a whole lot, not enough. There you go. It breaks down. See that volume right there? How it broke through? Pop. Hit it. Okay? I mean, that may not seem like a big move. All right, but on oil, I mean, that's 101.16 going down to 101.78. That's a 22. What is that? Or 101.18. Let's see, right here. Okay, yeah. So we're 101.18. So that's 18 cents. And that's 20. That's 38 cents. I mean, that's not like a big deal, but like an oil future, that's $3,800 or $380. Okay. So one contract, that's $38. So let's see what keeps happening. Let's keep going. I hope I plotted enough lines on it. Back up with some volume. So we hit that right there. Right back down. Pop. Brusting through it. We're definitely going up to 102. Let's see what happens. That's my opinion. Maybe I'm wrong. We'll watch it and see. Okay, magnet price is pulling it back. Or is it going down to 100.8? Bam! It's 100.8. Day's not over. I didn't draw enough lines to the downside. There it goes. Bust right back up. There we go. Okay, got 102. All right. And what time to get it by? Let's see here. Oil closed at 2:30. Yes, I didn't make it on the spread. But it still got there. All right. And it still would have been, I mean, if you're buying right off of it, I mean, you would have been fine. But not the total profit target you wanted, but it did hit it right to it. See where it goes next. Let's watch it. These are cool. You start drawing them, you'll start seeing, like, you know, what is the market drawn to? Where is it pulling off of? Where do I expect it to pull back to? You'll have some fun next week when we go over this, when we start applying this to binaries and start saying how can you use it on binaries too. Bam, right there. Goes to the next level. Comes right back. Now you're stuck in between these. Look at that. Right there. Oh, that's like a heavy level right there. Let's see what it does with it. It keeps trying, man. It wants to, but it doesn't have any volume to bust through it yet. Oh, massive gap down. Okay? Over here today. Big gap down in oil. So it's got to start all over again. Just hanging out. Really quiet, flat, crappy day on oil, but it still came in between the magnet prices. But I hope you're seeing that. I mean, that wasn't anything like massively complex there. You know, I just went through. And but yeah, these are the levels where the orders are, and it's where the orders have been, and it's how the market moves. So, let's see here. Do I have any questions left? So hopefully you just got the idea. Find high volume bars, draw them, and just go back and go back like 1 week, and then draw like the previous 2 weeks. Okay, and just draw some of these high volume bars and just watch it go forward. And as you learn to do this, I'm not saying this is like a 1 minute skill, okay, but it's also not like a 6 month skill. I mean, it's just try it multiple times over like the next week. And you'll be amazed at how well those levels really do serve as like little support resistance levels for you, and great target price levels when you're choosing your spreads. So it doesn't have to be arbitrary at all. Just find that average volume price and you'll be able to nail it. Yep. The box spread strategy would be good. The box spread isn't really a strategy; it's an instrument. But the spreads, I would actually not. I prefer during high volume, bigger moving times. I want the moves. I want the high volume moves. And one of the things like we have on here is like expected movement. So I'll go in like to expected range, and I'll choose volume. Right there. And what that does, that tells me actually how much volume I expect on any given hour. So I can see like what, you know, hours really high volume there, but basically what hours are really high versus what are really low. And because that's when I expect the larger moves to take place. I don't expect them during the lower volume times. I expect this during the lower volume times. All right, so I'm new to spreads. Can you go over those for me a little bit real quick? Yes. Let me do a quick recap on spreads. They're amazingly simple, okay? I All right, so we're gonna go over here. Boxes are sort of a good, those are a helpful little tool with it. But let's go over. We'll just look at, I don't know, US yen right now. Okay. The reason I'm bringing that up is because it's open with 2-hour contracts on it. Basically, the spreads are sort of like these boxes you have right here on the chart. Now, these are not meant to represent the spreads, but let me get rid of just a bunch of stuff off here. All right, so if I go in and I pull up, US yen right now, click on it right here. I go down here and I'm like, I just want one to expire in the next 2 hours or less. And so it'll narrow that down for me. And I'm also going to try to make it, let it expire at 10. So how long do I got left on these? 104 minutes. There we go. Okay, so these are all the 10 o'clock ones. And then let's just say I put like 0.5 in here. And the reason I'm doing this is so I can find the spreads really quick. All right, so we got basically a couple buys, a couple sell choices. One of those is like right in the middle. So now let's just say we don't want to risk more than 20 bucks to make it really simple. Okay. So right here, 103.30, 104.30, and then 102.30, 103.30. So if I look at that, what's happening is right at the top of the hour, like right when the spread started at 8 o'clock, they went in and they added 3 new spreads. Okay? And they do it every hour on the currencies. So we go over here, and so if the spread is 102.30 to 103.30, then right here at basically 8 o'clock, then they made a 102.30, goes pretty far down. It looks really big, but right there. All right, so 102.30, and it's going to go till 10, so we'd want to go over here. We got so basically to 2200, right? Because that's going to be 103.30. And then there's another spread that's right above that, and that's 103.30 to 104.30. So right here, 103.30 to 104.30. It also expires at 10 o'clock. So we'll just say this is the lower spread. We'll make it like a red color, okay? We got the upper spread. We'll make it green. And then there's one more spread that'll be right in the middle. That was that one I was sort of getting rid of when I put the max risk on there. Bring that one back real quick. And come on. Which is 102.80 to 103.80. That's the same spread. It's just one's long and one's short if you're buying or selling it. So 102.80 to 103.80. So I'll grab that one, 103.80 down to 102.80. Okay, so basically what they're doing is on the US yen, they're always going to be 100 pips wide. And they're going to put 100 pips above the market from where it started, 100 pips below the market from where it started, and basically 100 pips straddling it. So like 50 above and 50 below. That's where those strikes come from. Okay? Like they're always the same width. Where's the market at? One above, one below, one in the middle. All right? And that's so if the market moves up, you have one that you can sell, at low risk. So it's a pretty good combo. On every single spread, every pip tick, whatever you want to call it, if you're used to stocks, you're used to the word cent. It's the smallest increment move is always worth $1 on every spread. So now you can do 10 contracts and make it worth $10, or 100 contracts and make it worth $100. But the smallest variable is $1, which means you can really keep your risk very not only in control, but you can also really ratio it. Like if you want to risk, you can't do 1.5 S&Ps, right? Like it's an S&P E-minute. You're not going half, but you could do like 7 or 8 contracts over on Nadex versus doing, 2 full contracts. You don't have to compound your interest so high or your risk so high. it'll always tick in an increment of 1, whether it be 0.1 or 0.01 or 0.01, or maybe there's no decimal like the Dow. The last digit that it quotes in will always be a 1. Okay? So where that decimal's at, it'll be 1, 2, 3, 4, 5, 6. Okay? It'll always move in an increment of 1, and it's always worth $1. So you don't have to memorize all the weird stuff about futures and Forex and convert currencies and deal with the DAXs in euros and the Nikkeis in yen and, all that. You don't have to deal with all that. Okay? Everything's in dollars. Everything ticks in an increment of 1. Every tick is worth $1. If I buy it for, in this case, 103.37, okay, so the buy price, the offer, the right side here, 103.37. If I buy that contract, and I just click the button right there to open up for me, show it to me, then my risk is going to be between where I buy and the floor. So if I buy at 103.37 and my floor is 103.30, then that's a 7 pip or 7 tick, whatever risk. My risk is going to be $7 on the trade. Okay? So you take 103.37 minus 103.30, you get 0.07. That's 7 ticks. Remember, every tick is an increment of 1. Multiply that times 7. So 7 times 1 is $7. That's your risk on the trade. The amount of money you can make is from that price all the way to the ceiling. So from 103.37 up to 104.30. So if I subtract 104.30 from 103.37, just to save you some math, the number is 93. Notice 93 and 7 add up to 100, which happens to be the width of this. Now don't let that confuse you by seeing 100 and think that means that all of them like binaries are worth $100. Okay, 150, $400. There's even spreads like on crude that are worth $1,000. Okay, so right there. So they're not like binaries at all. Okay, they're completely different instruments. But your profit's going to be determined where you buy and you sell on the spread. If you hold it all the way, by the way, you can get in and out before expiration. You can hold it till expiration, like say till 10 o'clock in this case. If you do, the price as of that time, you don't have to worry about dark zones and stuff on spreads like binaries. But the price as of 10 p.m., the difference where you bought and sold will be your profit or loss. With your profit not exceeding the max profit, all the way up to that ceiling, which would be insanely nice to make 93 pips, between now and 10 o'clock on US yen. But it also will not exceed a $7 loss. And no matter how far the market moves against you, you can't lose more than $7. No matter, now if the market goes up, and let's say it goes to 104.30, 104.40, 104.50, just keeps flying up, you'll still be able to be profitable if it expires above the ceiling. You just won't anything, you'll be maxed out at the max profit. Now if it keeps going, you can always buy another spread, but wait until you start catching 90 pip moves before you worry about wanting to catch 200 and 300 pip moves. So that's pretty much how spreads work. You can buy them, you can sell them, you can buy the one above, sell the one below, sort of like I was showing earlier, make a straddle. Let's see, that would really be one. Let's see, 103.30, so we need right here. So, you can make cross straddles of different times. You can also flip it around and do iron condors. We talk about that a lot. Last week we had a lot of iron condors. Probably more than we've ever had. And so we actually put on the Saturday training page. I had lots of iron condors this week. Watch this training. So I went through and showed videos and from my radio show and from webinars we've done. And walk through those because we had so many of them. That's all the green ones are all iron condors. We actually ended up iron condoring the NFP also. Yeah, it's pretty rare to max out on a spread, which is good. You don't really want it to. Every once in a while it does happen though. It's sort of funny. People are like, "What do I do now?" And I'm like, "Just dance." You got the most you can get. That's awesome. But also, if you use something like price targets, it's a little easier to max out on that spread. Now, the other thing you can do is you can hedge with them. And I talk about that, how to buy the FX and sell the spread. Like right now, if you thought the US yen was going to be going up today, or whatever, you could sell the spread below it and buy the FX, and then the spread would make money while your FX is losing if it drops, and your spread would be capped at its loss, so your FX would be continue to be able to continue to go and make a profit. So that's pretty much, a quick summary on spreads. I know that's really a quick summary on spreads. A really good webinar to watch. I did one the other day with Trading Pop. Right over here. So if you don't understand spreads, start here. I really spent a lot of, it's only about an hour and a half, but I really thoroughly, step by step, drew it all out, laid out spreads. It's probably one of the fastest videos to watch right there. So if you just go to our news plan and click on, March 2nd, you'll see that in the very bottom one, I really laid the spreads out for you. Let's see here. Okay, so I'm new to spreads as well. If I was to start applying this method, how far back should I go back and research the levels to figure out where it's going to move to? Weekly news coming out? Should I go back a year to see how much it moves on average based on that particular type of news report? Okay, what I'm talking about on this for today is I'm talking more about the spreads themselves and combining them with the volume analysis. So that volume analysis really wasn't meant to be NFP. It just happened to be. There happened to be NFP reports coming out. But this is not really how much you expect the market to move on news. This is where you expect the market to go to based on the magnet. I mean, see, right there, that was the news. And look exactly where the market went. Right to the magnet price. Okay? So it's about having that. What price is the market going to be pulled towards because the orders are there. As far as the news, I've already done all the research for you. You're welcome to go back and do the last 5 years of data, but we got it all. Literally, we have it. It's right here, and it's free. Hop in, but it goes in and checks out and tells you your dollar moves this far on average, this far on this average, breaks this on this average. We lay it all out. And then there's NFP. There really isn't any major news this week. We had one major report, and that was the Ags report. That was it. I'll put a couple other things up this week, but there's nothing major. And last week, though, we had interest rate purchase, we had ADP NFP, we had Aussie GDP, we had Aussie retail sales, we had US ISM, we had the pound interest rate, we had the euro interest rate. Like I said, okay, on the pound, it's basically not going to move that much because it pretty much never does move that much. Our expectation of movement is, over here, 85 to 95 pips, but it really hasn't been doing it at all. And so I'm like, let's go in with this iron condor thing. It's going to be too expensive. And then I said, by the way, the ECB, the euro, never move, unless they change the interest rate, which I don't see them changing it from 0.25%, it doesn't move. So butterfly at 30 to 50 bucks. Boom, market was flat. I think there was a 2-tick difference between 8 and 10 a.m. And then, 6 and 8 a.m. And then say, hey, straddle this one. Straddle the press conference, because this thing's going to explode. And it did. It moved 100 pips. So we said it would basically move about that far. What do we say? It was at 78 pips. I guess it probably went 83. I'd have to go back and look at it. I did the archives. But, we go through. We lay it all out for you. So, if you want to go back and research it all, you're welcome to. But this is a lot of... It's not just movement. I look at how far it's moving, how long it takes to get there. I look at all the chart patterns on every event for every news report. And then how does that line up with every expiration possible? And are we better with binaries or spreads, straddles or iron condors, directional or, whatever. Does the market stall at the price because market makers are filling big orders at those levels? It's not always market makers. A lot of times it's just traders. So, it could be market makers, but it literally could just be traders. But what a lot of it is if you take on a massive position, you move the market all by yourself. Okay? You go and throw 100 contracts on gold, you're going to make gold move. Okay, now that's a big position. That's $10 million. But you're going to move it. You got to know where. Okay, this is what I talk about diagnostic trading. My show is called the Diagnostic Trading Hour. It's not really psychology. You got to know where the orders are. Because you got to get rid of those 100 contracts. If I want to buy 100, I want to unload 100. Okay? And so, if I'm going to buy a lot, hundreds of shares, or not hundreds, millions of shares, or if I'm going to buy, hundreds of futures contracts, which is called a CAR, 100 contracts, or if I'm going and doing 100 $100 million, $1 trillion transactions on FX. And I'm expecting to enter and exit at a certain point. Now, they may have been in this thing for a week or a month or 2 months or whatever, or they may just be in it short term, okay? But if I'm going to do that, I need to know where I can get out of the trade without starting to sell, and I'm selling so much that it's falling right back against me. I bought it. I want to be able to sell higher. I don't want to sell so much that the market keeps going down, okay? And that's where these magnets come in, because they see where are the orders, where have they been filled, where is the demand at, and once you know that, then you can go, okay, like if they're going to start buying this thing up, this would be a very realistic place to possibly start dumping some shares, okay? So it busts right through there, probably a very light volume, it pulls back, they buy them back up, and they're going for the next high volume price, and they're going to do that over and over again. Now, we didn't draw a whole bunch of these on USDN because I wiped most of them out. But it's literally just, it's not simply market makers. Market makers are there just to help facilitate, like an exchange is the intermediate, okay, providing anonymity, meaning somebody doesn't know who you are, if you're entering or exiting, if you're profiting or losing or whatever, okay? So they give you transparency, but they or anonymity, but they also give you transparency of pricing. You can see the limit orders, you can see the pricing out there. So you have transparency of pricing and anonymity. Then you have the market maker, which is basically saying, hey, I want to make sure there's liquidity in the market, and for that I'm going to buy at the offer, or buy at the bid and sell at the ask, and hopefully they can remain delta neutral. I mean, they want to be able to like unload those contracts. They're really not trying to trade against you. They're not trying to move the market. A market maker is trying to literally make bid ask and be delta neutral as much as possible, meaning they don't care about what direction it goes. They just want to get in and get out, get in and get out, get in and get out, okay? A market mover, hedge fund, big trader, institutional, bank, those are the guys that are worried about where they can get out of positions. Because they plan on holding them, but they also plan on getting out of them, and they want to know where are those orders at. And that's where those high volume bars come into place. So that's where a hedge fund would be looking to get out of a position. Yep. Not where they'd be looking to get in. And the problem is, you know what? We as traders sometimes sort of are very guilty, right? Of falling into the trap of, see, they think like I guess how do I put this? They think like a supplier, we think like consumers. And so we're like, oh, the market is taking off, and what do? Buy, right? I mean, I'm buying this, man. This thing's going to go all the way to 105. It's taking off, and then all of a sudden, how do I always seem to buy at the bottom and sell at the, or buy at the top and sell at the bottom? And we just feel like it's rigged against us. It's because we're thinking about consumers. They're thinking as a supplier, where are the orders going to be? Okay, so instead of making my trade based on when it gets there, I'm going to get my trade in first and get out when it gets there. I'm going to drive my truck, my ice cream truck, over to where all the kids are hanging out by the park, and I'm going to sell all the ice cream. Okay? So, I mean, that's what they're doing. They're like, the orders are there, I'm going to buy, I'm going to push it to this point, and I'm getting out. Because that was the last high magnet price. That's where a lot of the orders were built up. And, I mean, that's really all it is. It's that, I mean, if I can say that, it's that simple. So, I mean, that's really how the markets work. It's where the orders, the market goes to where the orders are, and if you can start figuring out where now I'm not saying you're always going to be able to pick direction, going to be perfect and everything else, but if you can use some of these things to help you, don't overcomplicate this, don't go draw 3,000 lines on your chart. Feel free to submit some charts inside Ninja. I'll be glad to, inside the forum on our website, I'll be glad to look at them for you. But just by learning to do this, you start thinking more like a market mover. More like, if I had, enough money to buy, 1 million shares of Google, and I wanted to buy it and I wanted to sell it, or I wanted to sell it and I wanted to buy it back, where would I expect it to be the right time to getting out of that trade? Same thing on S&P or Russell or gold or whatever. Volume. Where was the last place that there was a lot of pent-up trader demand and orders? And now that's where the psychology comes from. Nash, you mentioned psychology. You're not really trading the psychology, you're just trading the volume, but the reason that works is because there's a war story right there. Okay, one guy, he sold and he's just been praying every single day that the price would come back to it. Okay, it finally does. It's like, I'm out at break even. Another guy is making a bunch of money. It falls back, and he was just too greedy to get out. And finally comes back, and he's like, I can't take it, I'm getting out. Another person, it was stop losses. So they were in, and when it gets to them, they couldn't take it anymore. And so there's all these little psychological footprints that the volume is, and we can go, like, that's a whole big session we can go into. But the bottom line is, the high volume bars are where the orders are, and that's where the market's going to go. So it's that simple if you'll let it be. But anyway, so I hope that helps out a little bit. But if you have a target price, you can think about how much is my risk. Do I want to do a low risk or high risk spread? Okay. And by high risk, I mean they're all defined risk. They're not really ever high risk. But I mean, do I want to do a spread that's risking, $50 or $6? Obviously, I want the $6 one. But I mean, what's the break even distance on the trade? Is it a good idea? If I only expect it to move 2 points and I'm gonna have 2 points of break even, not a good idea. Now I could get one that's only like 2 or 3 ticks to break even, use a stop loss, and that spread could work for me. So by having that proper expectation, I can actually go, maybe I can go with the lower risk spread. And then, again, combining that with how long do I expect it to get there. If you have questions on how to, pull any of this stuff up, just let us know over on our website. We'll be glad to let you know how to do it. But, if you're wanting to know, like, how do I, figure out these expected range movements? And, we talked about this last week, like the boomerang. We do this all day and all night long, but all it is expected range. So right there, we're just going in and literally how far we expect it to move and just fading it again and again. But all right, well, are there any other questions? We got some great questions that came in. David, did I help you out on that? As far as the news, just check out our website on that. We'll save you a lot of time. And sweet. Thank you, Michael. So, Michael says it is. I don't know if I can quote exactly what you put, but yeah, thumbs up. It's nice to get real, simple, usable info on basic markets without it having to be all guru, secret, proprietary, etc. Just another great example. So, awesome. I'm glad you enjoyed it. All right, man. Y'all have y'all, and men and ladies, y'all have a great evening. And if you have any questions about this, let me know. It's a little bit new of a concept, but it's really simple, and it's something you'll use for the rest of your life if you're a trader. If you get it down, like you'll want it. It takes a little extra work, but you'll get addicted to it because you'll be amazed how accurate it is. All right, y'all have a great night.